So next up now, we're going to discuss fixed interest. We're pleased to have another visitor from our Chicago office this week, Miriam Schoblum. So Miriam is our sort of global director of fixed interest strategy, so works with our local teams and shares oversight of the ratings and research that we're doing on fixed interest right around the world. And so she is going to be introducing and moderating our two fixed interest panelists for today. So Miriam, over to you.
Thanks, Tim. And thanks everyone for staying for our fixed interest discussion. Today I'm joined by two portfolio managers with different investment styles, so I think we're going to have an interesting talk. I've got sitting right next to me is Ann Anderson, who's the head of Fixed Income Australia for UBS. And then just to the left of Ann is Anujeet Sareen, who joins us from Philadelphia, where he's a global fixed income portfolio manager for Brandywine Global, which is part of the Legg Mason family of asset managers. Thank you both for joining us today. So, as is tradition, we're going to start off with a couple of live polling questions. So if you would please get out your devices if you haven't already and take a look at this one. We'll start with, and I know you've seen these questions before if you've attended a conference here before. Does fixed interest still play a role in my portfolio? Is a question I've been hearing more and more over the past several years now. 1, yes, it's a defensive exposure that diversifies my portfolio. 2, yes, because my licensee requires me to hold it. 3, no, other assets such as cash, term deposits, and listed hybrids are sufficient. And 4, no, I don't need defensive asset class exposures. So as you're entering that in, I think we'll go ahead and show the results that we have so far. So pretty strong agreement for number 1 that it does provide some defensive exposure that diversifies the portfolio. So we'll just go ahead to the next one. My biggest concern about fixed interest at the moment is 1, the threat of rising bond yields, 2, persistently low yields that provide little income, 3, a turn in the credit cycle, or 4, none. So I think we can go ahead and show the results. We're getting some results up. The threat of rising bond yields so far is winning with more than half, so we have a majority. But it might be losing that majority, we'll see. Holding kind of strong at 50%. So that's interesting because we've asked these questions in the past. If you look at last year's results, we'd just been facing a period of rising yields in late 2016, so obviously rising yields are on everyone's mind. Last year, though, the winner was low yields was a bigger concern. And if you go 2 years ago, we see this flipping. So it seems like when yields recently have risen, it's on investors' minds. When they haven't or they've rallied, low yields is a bigger concern, but we're kind of splitting hairs, really, because yields on an absolute level have been very low for several years now. So you've matched the trend that we've been seeing in recent years with this latest question. I'm just going to quickly move through a couple slides to set the stage for our discussion. You all overwhelmingly agree that there is a place for fixed income, and these slides just show that. From a diversification standpoint, bonds have been still providing some benefits relative to equities in a portfolio. Nevertheless, this is a graph that shows the percentage of the Barclays Global Aggregate Index that has been negative yielding debt. It peaked around a quarter of the index last summer. It has come down since then. It's a little below 20%, but it's still significant. So I think this is one of those things that makes people question whether you want to be in a benchmark-focused type strategy. So I think we'll leave it there for now and then get right into the discussion. One thing, given the low yield environment we've been in, I've heard a lot of people ask, is it okay to be in a benchmark-focused strategy and just be making active bets relative to a benchmark? Or do I need to exercise maximum flexibility with an unconstrained bond approach? So I'd love to get your thoughts on this. And maybe we'll start with you, Anujeet.
So we're definitely in the camp that active management is kind of critical for in fixed income. I think no small part because most of the global bond indices, at least, their starting point is to invest in the most highly indebted, the most fiscally irresponsible countries in the world. So I think our own opinion is that you do need to pursue a pretty active strategy, and we think the wealth of opportunities when you open it up to the global marketplace is considerable, right? The currency and bond opportunities around the world, if you just look at the dispersion of returns between the highest and worst performing markets, is substantial, and still today, even in this lower yielding environment. And so the asset allocation opportunity, if you have a disciplined, repeatable investment process, I think can be very successful in capitalizing on those opportunities.
And Anne, let's shift and get your perspective on this. How flexible do you need to be successful?
I think it's, we tend to advocate being benchmark aware rather than benchmark driven. And I think it's very important to identify the right beta. The global bond market's 110 trillion as compared to the equity market, which is 65 trillion. We've got 25,000 securities just in the global ag. And there are so many degrees of freedom and decisions that we make and opportunities to add value within our asset class. So I think if you choose the right beta, and the events, for example, of last night to me once again reinforce that no one ever rings the bell around the surprises that the markets can deliver. Absolutely, we believe in activeness, but we also believe that you need anchor, at least as part of your fixed income allocation. I think unconstrained definitely has a place in an overall fixed income solution, but you must have some sort of anchor for your defensive part of the portfolio.
And that raises a question for you, Anujeet. If investors are really truly going to go with an unconstrained approach, what are the sacrifices they need to be willing to make? Is it a longer time horizon, or what would you say?
Sure. I think it's definitely a longer time horizon. I mean, if you really want to use bonds exclusively for protection, just volatility protection, and then you want to own the highest quality asset around to provide you protection in those moments. But I think that's the trade-off you have to make, right? But if you want to generate returns, in this lower yielding world, you have to decide what that volatility trade-off you're willing to take. I mean, our own experience has been that the longer horizon is important, partly because the pricing anomalies that you find in global fixed income, right, kind of correct over the course of a cycle. So you're talking 3 to 5 years is sort of the horizon where some of these pricing differences really come back to fair value. And sometimes that means some more volatility. I don't think that's inherently something we're trying to do, is seek out higher vol. But the pricing anomalies are realized, I think, over a longer horizon.
So let's shift and get into how you two have been positioning your portfolios and where you're finding opportunities. Since most of the audience is concerned about rising yields in some shape or fashion, but the nature of global fixed income markets is that not all yields are rising everywhere at the same time. And just, if you were going to look at how some of your portfolios have positioned over the past 6 months or longer, you went from an underweight to duration to an overweight for a period. So maybe we'll start with you and talk about what is your... Are you concerned about rising yields? And if you are concerned, where are you concerned and where are you not concerned?
Mm-hmm. We're thinking there is a gradual normalisation going on, and there's also a gradual reflation. The normalisation is happening firstly in the US, and the ECB is moving towards it. But we still believe that rates are going to stay very low, and what you think is normal is much lower than what we've seen historically. So it's a trader's market. You think there's not much vol, and there is. There's not a lot of vol, and then you'll get these punctuations and opportunities to be active. So we've been running long in Australia very selectively, long Australia, long New Zealand, because we didn't think the RBA would tighten, and we think that the budget and some of the changes there and the leverage means that they won't be able to tighten. What's going on in China? The Chinese yield curve has inverted, which is something hasn't happened for 10 years. That usually portends a slowing. So it's just, there's some cross currents in this world that we really have to be thinking about. The rally in the US last night, I think, is an opportunity to set yourself up to sell that market. Not yet, but it's an opportunity. So again, it's very much around choosing your markets, being active, and taking the opportunities as and when they arise.
Can you give us a preview? If we're not yet there, when will we be there?
Well, I think it's with what happened last night and this political capital, and one of our themes has been execution risk for policy, with this populism that you can say things, but then they bump into the checks and balances and they just ran into it, well and truly. So my baseline is, okay, take me back to where we were before the election. The economy arguably in the US is maybe a little bit softer. We've got this soft patch, but we're about the same. Europe is doing better. So I wouldn't expect that we go back to, say, 1.75, but I think it's possible we might move, the yields might fall a little bit further towards 2, and then that's an opportunity to set yourself up to lean against that, because the Fed will move again. They will tighten. The fundamentals should not dissuade them from doing that. This is a little bit of an interruption, I think.
Okay. And Anujeet, what about you and your thoughts on global interest rates?
Sure. So, we're a little less worried about rising interest rates given the backup that we've seen, but it's certainly the case. You showed the chart of 15% of the global bond benchmark having negative yields, right? There's still some significant amount of capital out there that's owning bonds purely from an insurance perspective. So to the extent that places like Europe and Japan and other places do better over the next few years, the reason to pay up for that insurance should decline. So we think European yields have a considerable amount of upside from here. We don't own any in Europe, and where we can, we're actually short some of that exposure. But we do think there is opportunity elsewhere. Our own process looks at where are the highest real yielding markets, adjusting for certainly credit risk and the like. And we think emerging markets is still the place to be for that. We're not a manager that's categorically in any one market, but we think emerging markets still have a lot of attractive opportunities. Mexico, for example, Mexican 30-year bonds today offer you a yield around 7.5%. Inflation has risen a little bit more recently, but long-term inflation is around 3 to 4. So that's a lot of real yield, for a country we think is solidly investment grade. Brazil's rallied a fair amount, but even there, inflation's come down substantially, and that rate cutting cycle isn't over. So we'd argue there are still, I think, a lot of opportunities in the emerging markets where you can get some, I think, strong income and capital appreciation.
Can you spend a little time, too, on where in the emerging markets you wouldn't invest at this point? I assume you need to be discriminate still.
Yeah, sure. So I think some of the lower yielding markets, maybe a little bit closer to China, we're avoiding. The likes of Korea, Singapore. I think some of those markets, we don't think they're credit issues. We just think they offer much value. I think some of the emerging markets close to Europe, where you've seen very low inflation rates in some of those countries, and policy has been very aggressive. Hungary would be an example, where we think rates are probably on the low side at this point. And those would be the markets that we're avoiding. And then there's some of the more, more politically risky places. Turkey's a challenging one on that score, where the politics, make it difficult to know exactly where prospective bond returns might end up.
How about you, Anne? Do you have any thoughts on emerging markets to share?
We tend to like emerging markets, but it's very selective. And a lot of the return comes from the carry and from the currency. So countries such as Brazil we find quite attractive and include that in sort of broader mandates. They've had a really good run, that's one thing, but some of the yields are really quite attractive, and even China, if you can buy China, the yields have gone up quite sharply. So we think that there's some good trading opportunities in those markets.
I'm going to stick with you, Anne. What's your favorite part of the bond market right now, where you're investing?
Favorite part? Well, the prices have moved, so it was favorite. I still like been long the front end of Australia selectively. The yields are quite attractive. I still think credit is okay. I think it's still, the fundamentals have improved. Certainly credit spreads have come down, but that's still an opportunity. I think also inflation. Inflation hedging has become really cheap. It tells you something about the world though. Inflation expectations are still very low and real yields are still very low. In Australia and in the US, 10-year real yields are 0.5%. So after all of this, the market's actually telling you something. So I think for people that are bearish about inflation or don't think that it will be anchored down at these extraordinarily low levels, I think that's an opportunity. So we trade the break-even spread in our nominal portfolios, which means that we opportunistically add inflation.
Okay. Anujeet, so you already mentioned emerging market local currency. I don't know if you'd call that your number one idea at the moment, but outside of emerging
Sure.
market local?
So outside of emerging markets, we have a pretty strong counter-consensus view. We think the dollar is headed lower over the next few years. We probably have our lowest position in the U.S. in a long time. What's interesting about the dollar is there's been two major bull markets in the dollar in the last 3 or 4 decades, in the 80s and 90s, and both those bull markets lasted about 6.5 years. This current bull market in the dollar started in 2011, so we're 6 years in. So we think we're late. We're late stages in the dollar. I think people are worried about what fiscal stimulus might come out of Washington and what the Fed might do, and hence, maybe there's more upside in the dollar, but we think those risks are really overstated. As Ann mentioned, we don't think, I think the politics in Washington are really going to constrain what President Trump can accomplish. And the U.S. just isn't differentiated like it was a few years back, right? Europe actually grew slightly above the U.S. In 2016. So there's been convergence. And so we think the dollar is set to decline, and the currency that I'd highlight there, I think, is the British pound. There's a lot of concerns about Brexit and the uncertainty around Brexit, but we think the currency is exceptionally cheap, more than compensating you for that risk. And importantly for the UK, its largest trading partner, Europe, is finally starting to grow. So there's a lot of upside, we think, on the trade side, even allowing for some competitiveness hits from Brexit.
I want to talk a little bit about corporate credit as well. I think when investors look at sovereign yields and think they're unattractive, corporate credit has been a place that people have gone a lot recently. Yet after we saw a commodity recovery and a rally for lower quality and the energy sector in particular, some say that valuations look pretty tight at present. Anne, we'll start with you and share your thoughts on what you think of the corporate markets.
I think starting with high yield, they've had a really nice run. So where we're taking risks, we've taken some profits there. The spreads have come down quite significantly. The default cycle, it's predicted to peak, and it's quite an unusual cycle because the US is probably later cycle. But with the loose monetary policy, the abundance of liquidity, low levels of interest rates, and still an okay profitability environment, overall that would favour being overweight credit. At the moment, IG, we would prefer to high yield, but should we see a correction in high yield, we would look to allocate back to it.
What are the factors that might cause a correction in high yield? Are there risks looming?
Equity market. If the equity market has a decent setback, driven by concerns about growth, political capital, uncertainty, you will see high yield widen. It's quite correlated to equity. So if we saw a correction there, that would be the chance. And some threat that we are slowing down. What would deliver a very significant correction, which is not our base case, is some sense of recession, which that's not what we're thinking. No one's thinking that perhaps, so maybe you should be thinking about it, but that's not in sight at this time anyway.
And how about your thoughts?
Sure. So on credit, like Ann, we're not particularly bearish on credit. We just don't think there's a lot of value there. In our kind of core portfolios, credit was north of 50% of portfolio. Going back several years, it's now a couple of percent. So we just think there's opportunity in other markets. So we just don't have much exposure there. I think the risks that we would worry about that might drive spreads wider are really kind of broader macro risks, which is some degree of policy tightening, right, that the global economy can't yet withstand. So something out of China, right? If they really go after the shadow banking system, and tighten the screws, and you get a real strong retrenchment on the industrial side, that might be problematic, I think, for credit. And certainly, ultimately, the risk that we always worry about, which is the Fed, that might go too aggressively at some point, either through the balance sheet or through the Fed funds rate. I think those would be the risks.
Well, I'm going to ask another question, but after that, I'm going to get to audience questions. So feel free to pull out your devices again and submit a question that way. And we'll also have folks in the audience with microphones so you can raise your hand. But since we started talking about risks to corporate credit, I guess just risks more broadly, bond managers are the most worried people I know. So what's keeping you up at night today, Anne?
So it was execution risk, not just in the US around the fiscal agenda, but also Brexit. We think the European situation has settled down, that there's still a shift to populism, but it's not a significant shift. Policy mistakes, so the Fed, if the unwind of their balance sheet causes the market to be worried, but they're setting us up very nicely. They're communicating clearly. This is one of the things we follow very carefully. I think they're going to do it very gradually, but that's a risk, particularly if you have a confluence that the ECB Draghi starts talking about unwinding the European. They're not unwinding the balance sheet, but they start to taper. As long as that's handled well, but that's certainly a risk because we've never seen it before and we're not sure what it will look like.
How about you, Anujeet?
Sure. So I think what Anne was talking about, I think on the balance sheet, I think that's a really critical issue. I think the Fed's going to go out of its way, right, to telegraph a very gradual unwinding of the balance sheet, but it's unclear exactly how the markets respond to it. I mean, if the Fed says, look, we're only going to reduce the mortgage book, right, which is whatever, 1.6 trillion, but we'll do it over 4 or 5 years, does the market, present value that and say, gosh, that's a lot of duration to hit the market, even though it's staggered? Some analysis suggests that the risk premium in the bond market, if it's done over that period of time, would rise by about 10 basis points every year, and that's certainly manageable. But it's unclear. We don't even when the Fed first started with QE, right? The first QE, it was just new ground, right? So in fact, bonds rallied prior to that and sold off, right, as QE started. So I think there's just some uncertainty around how the markets process that. And then I think the political risk in Washington is worth watching. I don't think that destabilizes the global cycle. I think it creates pockets of weakness in equities and the like. You probably get less fiscal stimulus if this continues towards something as serious as an impeachment. But I don't think that generates a sufficient tightening of global conditions to really derail the global cycle. So I'd really still come back to China. After the Party Congress in the fall, we really need to understand what does Xi Jinping want to do. There's been a trade-off in the last 2 years where they've said, look, we want to support short-term growth at the expense of some longer-term goals. If they reverse that, I think that's a risk.
And given the risks that you've discussed, are there any positions, are there just things you're watching, or are there positions in the portfolio that act as hedges in any of those scenarios?
Yeah. So certainly I think our longer duration position at this point in the U.S. serves partly that role. We think real yields, we think the treasuries are fair value. So we do have some exposure there. I think that's partly a hedge. And then in portfolios that permit, we have some short positions in certain select Asian currencies as an offset.
How about you, Anne? In
terms of hedges, a long duration, but that has played out as we thought, so I'm looking to take profits on that. A bias to the front of the curve, but then a convexity trade being overweight very long bonds, which benefit in a rally, so it's type of a barbell. Trading up in quality in terms of credit, so buying infrastructure, utilities, more defensive, less sensitive to things going wrong in China. Aussie banks, not underweight, but they've had a good run. So, there might be a bit of noise there, particularly if we have a sovereign downgrade, because this time it will be because they have a sovereign downgrade, but it's also because of asset quality declines.
Okay. So we're going to go to audience questions. Just this one very general question. Given the global fixed interest index is full of significantly indebted countries, why would you pay any attention to the index at all? So, Anne, maybe you could start and take that.
Well, sovereigns have the ability to print money, and I'm pretty confident that we're reasonably good at choosing countries that won't default. We do our own credit research. We obviously look at credit rating agencies, so I'm pretty confident that countries such as Japan and the like, yes, we're underweight, but we'll own them because remember, if you're an Aussie investor, you hedge back to AUD. So even though the yields are negative, you actually get a huge uplift from the forward points coming back into our market. So look, there's heaps of opportunities. And it's just a matter of time horizon as well. Something might eventually happen in Japan, but I don't think it's in the next couple of months, let's put it that way.
Okay. And Anujeet?
Well, yeah, we'd certainly agree with that sentiment in that question. I mean, in a lot of the portfolios that we manage, I mean, there are different, we'll have multiple, benchmarks, and the underlying portfolio will look identical. Because our approach is kind of where's the value, and just because a benchmark contains bonds that we think doesn't make sense is not going to prompt us to certainly own them. So, again, it's the time horizon that matters, right? Can JGBs rally as they did for a quarter or two the first half of last year? They can, right? And you can get some outsized returns for a short period of time. But over the course of time, I don't think they're going to be a significant contributor to performance for your portfolio, and so we would avoid that exposure.
Next question, I'll let you take this one, Anne. Is the Australian bank tax and house price bubble a concern for Australian bank debt?
It's at the margin for bank debt. I think it's a macro concern for the economy because if the banks pass it on, which they probably will one way or another, that means that we have a tightening in financial conditions at a time that households are extraordinarily leveraged. So the policymakers have got a very challenging course to track. So I'm not worried about bank debt, but all roads lead back to the banks in Australia. So it's very important to understand how these types of policy changes trace through our economy.
It's more of a question for me on that particular issue, which is, it's just really hard to find any housing bubble that bursts entirely through regulation, macroprudential sorts of measures. And until you have a meaningful interest rate cycle, does property anywhere get disrupted? I mean, I don't necessarily know the answer to it, but the historical evidence says you kind of need a rate cycle. And until such time, it can moderate, it can decelerate, but not something more cataclysmic.
Are there any, just going to scan the audience, any hands? No, okay. Well, I've got another question. I think since the financial crisis, liquidity risk has been on bond managers' minds more and more. Are there areas, especially as banks aren't making markets in certain areas of the market like they used to, and are there areas of liquidity risk that you are concerned about as you manage your portfolios? Anne, I'll start with you.
Look, there's amazing liquidity at the moment. We just funded a new mandate last week, and we cannot find corporate bonds to fill it up. In Australia, there's just a lack of supply. So it's actually interesting. So that's where you would normally be concerned about liquidity, but there's still abundant liquidity. The reality is it's 10 years on from the beginning of the roll into the crisis. So it's, I said to a colleague the other day, I said, gee, this has been a good run. So when it's over, the hangover will be big. But at the moment, we don't see the circumstances that lead us to that. But with credit, you have to leave early. Yeah, you have to leave the party early for sure.
So I think it's a really good question. I think there's certainly supply-demand elements, when demand is just running for yield. In particular, there's liquidity in markets. Our own view is that I think there is a structural shift that liquidity just isn't what it was, certainly in the last cycle. And so our approach to handling it is just consistent with a time horizon, right? If you have a long time horizon, you have a low turnover approach to fixed income, liquidity is just less of a concern. And that's kind of how we approach the market. So it happens to affect us less. Will be interesting to see in the next recession how liquidity affects pricing.
You mentioned, well, actually, so I have a question here, and I'll confess my ignorance being from the U.S. and I've noticed that Australians have really great ways of abbreviating things. So I have a question that is, can you share your views on Supras, which I'm going to assume means supranationals?
Yes.
Okay. Thank you for bearing with me. So I'll pose that question to you both.
Okay. We have a lot of supranationals that tap into our market. It's more reflective. So these are the EIB, KfW, which is a German sovereign and the like. They tap into the Australian market. They're actually a huge issuer here. The main reason being because lots of foreign investors like Aussie bonds, like Japanese, so they buy those bonds, and also foreign central banks. So look, from time to time, we find opportunities. We've tended to like the sovereign-backed, so the KfWs and the like. That's what we've tended to be overweight, as distinct from other parts of Europe, given some of the fiscal challenges. But at the moment, we don't see a lot of value there.
Okay.
Yeah, I mean, it's similar. I mean, we don't own much in credit generally, right? So we don't own much in Supras either. The only place that we would have some exposure to Supras would be in just some of the cash management, components of the portfolios. We're trying to add a little bit of yield to the cash piece, in something very, very high quality.
Okay. I guess another question for you, Anujeet. You mentioned a local currency, emerging markets. What are your thoughts on the hard currency market?
Yeah. The run in the hard currency markets, I mean, Brazil as well in local, but the run in the hard currency markets has been very, significant since the peak levels back in early 16. So to us, a lot of that emerging market credit is, similar to the broader credit indices, where there isn't a lot more value, we think, to extract there. It's the local market that I think is the opportunity.
And I think one more question we'll take. This one is for you, Anne, and I'm really glad that this question was asked. Would Anne expand on her comment about the strong run and hangover when it ends? What would that look like?
What would it look? Well, so that means that the credit spreads, it'll be a jolt, because all the markets have enjoyed the support of the central banks. And there's been, I wouldn't call it complacency, but there's been this calm that the central banks have sort of quelled volatility. And so I think when it comes, it will be a bit of a shock. And the thing is, like memories, some people were in the market and many people weren't in the market when we rolled into the financial crisis. So what will it look like? I'd say that spreads will widen on high yield several hundred basis points, and it will probably happen quite quickly and surprisingly. So people will take a big hit to portfolio value. A little bit like the fourth quarter of last year, it was rate driven though, if you remember that we had some negative returns from the fixed interest market, which shocked people, but then we quickly recouped that.
Given that you're out of credit in your portfolios, maybe are you thinking much to how it's going to look when the credit cycle eventually turns?
It's hard to know ex ante exactly how it'll play out. Like I said, it could be, we are 8 years into this expansion, right? this is the kind of the point in the cycle where it's, some challenging things can surface, and I think widen credit. Some of it is, I think, we're watching issuance trends, where is the debt being issued and for what purpose, to the extent that it's going into, some slippery places or for questionable purposes, that would get us more concerned. We're not at a point yet where we have that concern in aggregate, but I think we're looking for where's the credit going, how much it's being issued, and then that intersection with policy.
Thank you. So I think that's all the time we have for questions, but before we feed the people, I'd like to just come back to you for final thoughts. Anne, we'll start with you.
Final thoughts. I just believe that, you're paying us to manage your money. We see it big and we see it small. Australians don't invest a lot in fixed income, unfortunately, unlike other countries. But I think as our economy matures, and given the concentration of our equity market, I think it's important for investors to think beyond term deposits and hybrids as an anchor for fixed income in portfolios.
How about you?
Well, I think this conversation from that earlier session about active versus passive. I mean, I come from a very active management place, and so I'm going to talk my book here for a minute. But I think the question about active management in fixed income is a really good one. I mean, we're now at yield levels that are challenging for a lot of purposes, and to the extent that you have a manager that's willing to and shows a skill that I think that can allocate capital around the world, I mean, you can double the underlying yield of your portfolio through active management performance, which fortunately we've been able to do. So I think we're taking a hard look at how active management is done in global fixed is I think worthwhile. The other I think difference between I think some of the equity debate, right, is the you don't have components of a bond benchmark that can go up 5-10 times, right? So I think the bond world lends itself to more of a mean reverting quality. Again, if your horizon is long enough in terms of valuation anomalies, it's a more, I think, in that sense, a fruitful place for persistent active management added value.
Well, great. We'll end it there. Please join me.